Waratah Capital Advisors Limited, a prominent Toronto-based hedge fund manager overseeing $4 billion in assets, has disclosed a cybersecurity breach, potentially exposing sensitive client data. The breach, discovered on June 24, involved unauthorized access via a third-party IT provider, impacting backup systems rather than Waratah's internal network. The compromised data includes investor names, social insurance numbers, and account details. Waratah has notified law enforcement and is offering affected clients 2 years of complimentary credit monitoring as it continues to investigate the incident's full extent. This breach highlights the increasing vulnerability of financial institutions to cyberattacks, despite robust security measures such as advanced firewalls and regular penetration testing. The incident underscores the growing need for cyber insurance and enhanced cybersecurity protocols across the sector. Similar breaches have affected major Canadian entities like LifeLabs and Desjardins Group, indicating a broader trend of rising cyber threats. As technology evolves, financial firms, especially smaller ones, face challenges in keeping pace with sophisticated hacking techniques, emphasizing the importance of vigilant cybersecurity practices and third-party risk management.
Opendoor Technologies, Inc. has recently experienced a remarkable surge in its stock price, skyrocketing from approximately 50 cents in late June to nearly $5 by July 2025, marking a tenfold increase. This dramatic rally has drawn comparisons to Carvana's legendary comeback, as both companies share a similar business model of leveraging technology to disrupt traditional asset-heavy industries. Opendoor, often misunderstood as a mere meme stock, is utilizing its AI-powered automated valuation model, AVM, to create a real-time real estate trading platform, positioning itself as a tech disruptor rather than just a home-flipping company. The market conditions appear favorable for Opendoor's resurgence, with mortgage rates expected to decline from the current 6.7% to around 5.8% by late 2026, and housing inventory remaining tight. Opendoor is poised to capitalize on a potential housing market rebound. The company has strategically streamlined its operations by reducing inventory, tightening its buy box, and focusing on high-confidence flips to preserve capital and decrease cash burn. As the market narrative shifts and Opendoor's technological capabilities gain recognition, it could transform from a perceived meme stock into a formidable AI-powered real estate platform, potentially driving further investor interest and stock appreciation.
Japan's recent political upheaval, marked by Prime Minister Shigeru Ishiba's defeat in the upper house elections, has weakened its stance in trade negotiations with the United States. Analysts from Quantum Strategy and Oxford Economics suggest that the U.S. is likely to adopt a more assertive approach, potentially leveraging Japan's political instability to push for more favorable trade terms. The loss of the upper house majority by Ishiba's ruling coalition has opened the door to a no-confidence vote, further complicating Japan's ability to negotiate effectively. This political vulnerability may lead to the imposition of a 25% tariff by the U.S., as President Trump has indicated a tough stance, particularly on issues like agriculture and auto concessions, which are vital to Japan's economy. Despite the bleak outlook from some analysts, HSBC presents a more optimistic scenario, suggesting that the conclusion of the elections might provide Ishiba with the flexibility to compromise. Potential concessions could involve increased imports of U.S. goods or easing non-tariff barriers, which could in turn lead to some U.S. tariff relief. However, the complexities of the negotiations, coupled with the strategic importance of maintaining a strong U.S.-Japan relationship, mean that any deal will need to carefully balance domestic political pressures with international trade demands. The situation remains fluid, with the possibility of extended negotiations and shifting deadlines, as both nations navigate the intricacies of their economic and strategic interests.
The recent hedge fund and insider trading news spotlighted several notable figures and entities, including Warren Buffett, David Tepper, and George Soros. Warren Buffett addressed rumors regarding Berkshire Hathaway's BNSF potentially engaging Goldman Sachs for a railroad acquisition, dismissing such reports. In a strategic shift, David Tepper's Appaloosa Management divested its entire stake in Advanced Micro Devices, opting instead for investments in two stocks with the potential for a tenfold market expansion by 2033. Meanwhile, George Soros faces scrutiny as watchdogs call for an investigation into his backed nonprofits for alleged misuse of tax-exempt status. In the broader hedge fund landscape, Citadel Securities cautioned the SEC against hastily rolling out tokenized securities, reflecting concerns over regulatory readiness. Concurrently, Walleye Capital, aligning with other multi-strategy hedge funds, announced it would not accept new capital, indicating a strategic focus on current asset management. Additionally, Newegg Commerce Inc. experienced significant shareholder activity, which could signal shifts in market confidence or strategic direction. These developments underscore the dynamic nature of hedge fund strategies and regulatory interactions, influencing market sentiment and investment strategies.
Westpac New Zealand has identified a significant financial issue affecting consumers, termed the subscription trap, where individuals inadvertently incur recurring charges from overseas-based merchants. The bank has intervened to prevent over $25 million in unwanted charges by blocking payments to businesses that obscure subscription details in fine print and make cancellation difficult. This initiative, launched in April 2024, has already protected 20,000 customers. Westpac's head of customer care operations, Peter Barnes, emphasized that while these businesses may not be acting fraudulently, their practices are unethical, often leading to customer frustration and financial loss. This proactive measure by Westpac highlights a growing concern in the digital marketplace, where consumers are frequently ensnared by misleading subscription models. The bank's strategy not only safeguards customer finances, but also enhances its fraud prevention systems with biometric technology and other measures. The move underscores the importance of consumer vigilance when engaging in online transactions and reading the fine print. Westpac's collaboration with other banks on this issue reflects a broader effort within the financial industry to address and mitigate such consumer risks, potentially setting a precedent for global financial institutions to follow.
The White House has announced the framework for a new trade agreement between the U.S. and Indonesia, marking a significant step in bilateral economic relations. Under the proposed terms, Indonesia will eliminate most tariffs on U.S. goods, while the U.S. will impose a 19% tariff on Indonesian imports. This rate is higher than the general U.S. tariff baseline of 10%, but represents a reduction from the previous 32% tariff under the Trump administration's earlier policies. The agreement aims to enhance market access for American producers and digital services, addressing long-standing trade barriers faced by U.S. businesses in Indonesia. The framework also outlines substantial commercial deals, including a $3.2 billion aircraft purchase and $15 billion in energy product transactions. These agreements are expected to bolster trade relations and reduce the U.S. trade deficit with Indonesia, which stood at $17.9 billion in 2024. As negotiations continue, both countries will finalize the agreement and address non-tariff barriers to further facilitate trade. This development is part of the broader U.S. strategy to secure fair and reciprocal trade agreements with key partners, following similar frameworks with countries like Vietnam and the Philippines.
Brazil and Verifone have announced a partnership to introduce Brazil's real-time payment system, Pix, to the U.S. market. This collaboration will allow Brazilian tourists in the U.S. to make payments in Brazilian reais using Pix directly at the point of sale. The initiative is particularly significant for U.S. merchants in high tourism areas like Florida and New York, where Brazilian tourists who spend over $4.1 billion annually represent a substantial market segment. Pix, launched by Brazil's central bank in 2020, has rapidly become a cornerstone of the country's digital payment landscape, processing 64 billion transactions last year and surpassing traditional debit and credit card transactions. The introduction of Pix in the U.S. is set against a backdrop of increasing global adoption of digital payment solutions, with mobile wallets and real-time transfers gaining popularity. This move by Brazil and Verifone not only enhances convenience for Brazilian tourists, but also positions U.S. retailers to capitalize on this trend. However, the expansion comes amid a U.S. Trade Representative (USTR) investigation into Brazil's digital trade practices, which, although not explicitly naming Pix, highlights concerns about potential trade imbalances and competitive disadvantages faced by U.S. companies in the digital payment sector. This development underscores the growing influence of digital payment systems like Pix in reshaping global commerce and financial access.
Cleveland-Cliffs Inc. has garnered renewed optimism from Wall Street following its second quarter 2025 financial results, which surpassed expectations. The steel producer reported a narrower adjusted loss of 50 cents per share and revenue of $4.93 billion, driven by record steel shipments of 4.3 million net tons. Despite a decline in average selling prices, the company achieved positive adjusted EBITDA of $97 million, attributed to aggressive cost-cutting measures such as the idling of 6 facilities, which reduced steel unit costs by $15 per ton. KeyBank Capital Markets analyst Philip Gibbs upgraded the stock to overweight, setting a price target of $14, citing improved risk-reward dynamics, operational efficiencies, and favorable trade policies under the Trump administration. The company's strategic focus on cost reduction and operational efficiency, particularly in its high-margin automotive segment, is expected to enhance its financial performance. Gibbs revised his 2025 EBITDA forecast to $419 million, more than doubling his previous estimate, and raised expectations for the third quarter to $197 million. Looking ahead to 2026, Gibbs anticipates further financial gains, projecting an EPS of 42 cents and EBITDA of $1.86 billion, with potential upside if steel prices outperform. Cleveland-Cliffs is also exploring asset sales, engaging J.P. Morgan to facilitate the divestiture of non-core properties, which could yield significant financial benefits. Despite the positive outlook, risks such as steel price volatility, trade policy shifts, and interest rate changes remain. Following the earnings announcement, Cleveland-Cliffs shares rose by 6.01% to $11.30.
Verizon Communications has surpassed Wall Street expectations with its second quarter financial performance, reporting a 5.2% year-over-year revenue growth to $34.50 billion, which exceeded the consensus estimate of $33.57 billion. This growth was primarily driven by strong sales in wireless equipment and broadband services. The company also narrowed its adjusted EPS outlook to $4.64 to $4.73, slightly above the consensus of $4.68, and increased its free cash flow expectations for 2025 to $19.5 billion, $20.5 billion. Analysts from RBC Capital and Raymond James have adjusted their price targets for Verizon, reflecting the company's robust financial execution and strategic focus on high-margin subscriber growth. Despite these positive results, Verizon faces challenges in subscriber growth, particularly in its postpaid phone segment, where it reported net losses. However, the company remains optimistic about its long-term growth prospects, focusing on advanced 5G initiatives and AI-driven infrastructure investments. Verizon's strategy includes operational efficiency gains and disciplined capital spending, which have helped offset some of the pressures from subscriber softness. Additionally, favorable tax legislation is expected to provide significant cash flow benefits, further supporting the company's financial outlook. Verizon's stock has reacted positively, trading up 0.61% at $42.77, and continues to offer an attractive dividend yield, positioning it as a defensive investment with strong recurring revenue.
Guidance Capital Inc. has increased its stake in General Dynamics Corporation, NYSEGD, by 8.6% during the first quarter, now holding shares valued at approximately $963,000. This move is part of a broader trend among institutional investors, with major entities like Vanguard Group Inc. and Capital Research Global Investors also boosting their holdings in the aerospace and defense company. As of now, institutional investors and hedge funds own 86.14% of General Dynamics stock, indicating strong institutional confidence in the company's performance and future prospects. In related developments, Deutsche Bank Aktiengesellschaft upgraded General Dynamics stock from a hold to a buy, raising its price target from $298 to $342. This reflects bullish sentiment among analysts, as evidenced by the consensus hold rating and an average price target of $294.53. General Dynamics recently reported quarterly earnings that exceeded expectations, with a 13.9% increase in revenue year-over-year, driven by its diverse operations in aerospace, marine systems, combat systems, and technologies. The company's robust financial performance, coupled with a healthy dividend yield of 2.01%, underscores its appeal as a stable investment in the aerospace and defense sector.